All right, everybody. One thing I wanted to mention, you have to remember that we are trading in a macroeconomic fundamental approach, or with a macroeconomic fundamental approach. Okay? So it is very important that you keep your exposure to a minimum, because when you have big emotional moves that are driven not by the fundamentals, but just by the panicky crowd or emotional reaction of investors, or maybe some policy move that really doesn't change the fundamentals, or even if it does, you need to be able to withstand those moves. If you're in Forex and you get a 2 or 3% move, which might equate to 2, 3, 400 pips, but the fundamentals haven't changed, you need to still stay in that position. Okay, we are dictated, the fundamentals, the position is dictated by the fundamentals. Uh, and of course, those of you who subscribe to MMT Trader, you have a breakdown of those. I do the analysis every week. It's very much in depth. And you know what I look at. You know what I focus on. And this is the correct information. It's the correct breakdown of that information. It's the correct understanding of that information. And it's the correct application of our trading and our investing to profit from those conditions. Okay, but you need, now, let me just qualify this. I'm really speaking to people now who are trading with leverage. So I'm talking to you people out there who are Forex traders or futures traders, or options traders, especially if you're selling naked options. You need to keep your exposure down to a point where if you have something like the British pound move post-Brexit. By the way, I was not in the British pound, and I told all of you, I don't trade these events because you never know what the reaction is going to be or how extreme it's going to be. You don't know what the result of the vote was, or was it what it was going to be, despite the polls leaning in a little bit in one direction. And you did not know the extent of the reaction. The reaction was crazy. What I said is, and what I tell people, wait for these events. Wait for the 100% to make their wrong move, which they do every single time, because they don't understand what's going on. They don't understand the impact it's going to have on economies or markets. Wait for that to happen, then go in there and take their money. It becomes an easy game for us. But in the event that you are caught in a situation, you need to have your exposure down at a level where, for example, I could have survived easily if I was long that British pound at 145 just before the vote, taking a shot. If it went when it went all the way down to 128, that my exposure would have been such that I would not have been blown out. So you have to go about it that way. You have to. Now, what this means is you'll build up profits more slowly, but you're going to have profit after profit after profit after profit after profit, literally profits all the time, okay? Because even in bad situations, you'll have enough capital. Your position won't be a debilitating one. There's no risk of catastrophic loss. You'll be able to work out of it calmly and, effectively. So always keep that in mind. You want your positions to be at levels that are low risk-wise, okay? Especially for you beginners, because you want to build up confidence in the approach. And remember, you don't have to make a lot of money. It compounds very, very quickly. If you make 0.2% per day, if you average that over 1 year, that's 100% return. 100% return is huge. That compounds so fast over years. Even if you make 0.1% a day average, you make a 50% return in a year. So that's huge money. Remember, Warren Buffett built a $60 billion fortune making something like 20-25% over the course of his investing lifetime. So those are huge numbers, man. So it works. The whole thing works. Just remember, keep your risk size down. Keep it manageable, and you'll be fine. You make money every time. You'll be fine.